What's up, weekend warriors? I'm research analyst Nick Antonucci, and this is your Casual Finance Friday from Henssler Financial. Today, we're going to be tackling the dreaded topic of fees and help you understand the fees you're paying and maybe uncover some of those that you didn't even realize you were paying.
Get down, baby.
So if you have a financial advisor, it should be no surprise to you that you're paying that advisor a management fee. After all, there's no such thing as a free lunch, right? But what do you get for those fees? Well, this is certainly going to vary on a case-by-case basis. But generally speaking, your advisor should be coaching you through your many financial topics, including how much money you need to save, what type of accounts you should save to, what investments are right for you, and the kind of insurance you need. Other topics might even include tax and estate planning. Now, the level of assistance you require and the amount of assets you have will be two of the biggest items that dictate your fee level. So let's dig into an example. Let's say that the average advisor fee ranges between 1% and 2%, and you have $1 million. If you're paying an advising fee of 1% to manage these assets, that means you'll be paying an advisor $10,000 a year. But for this $10,000, you have a professional advising you on the right investments for your particular situation, something you likely don't have the training to do on your own. Now, if you're a beginner investor, on the other hand, who has opted to go the robo-advising route, it's likely much less, let's say 0.5%. And on a $10,000 account, that's only $50. But as we all know, the fees don't end there. Once your advisor chooses the investments that are right for you, the fees could grow. Let's say your advisor, like many, chooses a portfolio of funds for you to invest in. Each of these funds will charge a management fee known as the expense ratio. After all, an asset manager isn't going to manage your money for nothing. These fees are generally known as the operating costs for the fund. You won't see a line item deducting these in your account. Rather, they're paid out of the fund's overall assets, not billed directly to the individual shareholder. Now, this expense ratio could range from as low as a few basis points for ETFs to more than 1.5% for some actively managed mutual funds. Keep in mind, there are some great resources available for you for free to determine if you're paying too high of fees on your funds. Take Morningstar.com, for example. It'll tell you the fee on any fund that you'd like to see, and will even go a step further as to categorize the fee as low, average, or high. Something else to watch for on funds is sales charges or loads. There are two types of loads, front end and back end. And as you can guess, the name refers to when the fee is charged to you. Funds who charge a front end load take the charge off your initial investment. So let's say you invested $1,000 in a mutual fund with a 2.5% front end load. Before your money's even invested, the fund company takes $25. This means you need to make more than 2.5% on this investment just to get back to even. A back end load means that the fee is charged when you sell. So let's say you invest $1,000 in a fund and that investment grows to $1,500. If the fund has a 2.5% back-end load, the company will take 2.5% of that $1,500 you have when you go to sell the fund. That's $37.50, not even including the management fee you've paid them along the way. In most cases, however, a back-end load decreases the longer that you hold the fund. Nonetheless, we typically recommend avoiding funds that charge any type of sales charge. Now, if you're fortunate enough to have enough assets to invest in individual stocks while obtaining a well-diversified portfolio, you can avoid many of these fees associated with a fund. One fee that's tough to avoid in any case are commissions. This is the fee that you pay every time you buy or sell a security, whether it be a stock, a mutual fund, or an ETF. Commissions have come down significantly in recent years, and some brokerage firms offer no commission trades on a very select list of funds. But generally speaking, you should expect to pay a commission of about $5 per trade, so $5 to buy, $5 to sell. Do you feel like you're being nickeled and dimed yet? That's why it's important to talk to your advisor and understand the fees you're paying and ensure that your needs are being met. My name is Nick Antonucci, research analyst at Henssler Financial, signing off on a very casual Finance Friday. Thank you for watching.